Welcome everybody, my name is Brian LeBlanc and this platform is Where Rebels Are. Today we're going to talk about options, and I'm starting from the very bare bones basics, okay? How do you trade options when you're getting started? Well, in order to understand how to trade them, I'm also going to have to give you guys an introduction on how, or I should say what they are and what mechanics you should be aware of, how they're used, how they interact with the market. One of the easiest examples that I've come across in my career to getting your base understanding on what an option is to pretend like you're trying to trade an option on a house. When you're talking about the stock market, generally speaking, you're provided a share, which this day and age is always digital. It's represented in your account and it's tracked by your broker, and it just has numbers and letters, and it tells you how much the stock has gone up or down. Well, that certificate represents an ownership stake in a physical company that does business across the world. Companies aren't technically physical, right? It is a name, it is a concept under an umbrella that conducts business and is run by people, and it buys assets, sometimes buildings, and it sells things, hopefully, to try to make money. So that's the basic super introduction to what a stock is. Well, an option is a contract on a stock. So I'm going to use options as an example on a house. First thing you should be aware, a house right here looks nice. We're going to say this is a $250,000 house. Arbitrarily, no rhyme or reason here. The first thing that you can do with an options contract is decide, do you think that the price is going up, or do you think the price is going down? So if you think the price is going up, let's do this, center it that way a little bit more for visible, you would buy a call option. What the call option does is it allows you to pay a fraction of what the house is worth, because you're not taking actual possession of the house. You are just buying a contract that says if the house increases in value, you have the ability to buy the house at a specific price, which is referred to as the strike, within a specified period of time, which in this example, we're using an expiration of 1 year. So how much would you expect to pay for a contract like this? Currently trading $250. You got a whole year's time. So you're going to have what's referred to as time and volatility value. This number represents, and we'll say this is, let's go with 20,000. Okay. This number represents the hypothetical value only. All right. This is taking into account that the house is not yet worth $300,000. It is also taking into account that you have some time and that the markets are overall rising. So that's going to be your introduction to time and volatility. This is referred to as part of the premium that you pay because whenever you trade in a contract, there's an exchange of capital. The next thing is intrinsic value. And what this value represents is if the numbers were flipped, as an example. So let's say the options price was at at 250,000, but the house itself was only worth or was actually worth more at 300,000. Let me say that again. The intrinsic value, you'd have to kind of flip the numbers here for it to make sense. So we're going to assume that the house is worth 300,000 and that the options strike price represented 250. Well, in that case, the call option would be considered in the money. And if it's considered in the money, then it would have an intrinsic value of 50,000. Okay. Now, that's only true if there's a flip. However, as we have it now, this is considered out of the money call option because the strike price is higher than the actual value of the house. So intrinsic value in this contract is technically zero. And in order to figure out how much you're paying for the contract, you add what the intrinsic value is plus the time and volatility premium, and that'll give you the total cost of the contract. So the contract now is equal to the price above. And we'll just do an arrow up. Okay, so this is the contract. Simple as that. Now, on a put option, your expectations are flipped. Okay, when you're dealing with options, you have calls and you have puts. So if you have the ability to bet that the price of an asset may increase, then why doesn't it make sense that you should also have a counter bet available to you on that? And that's going to be represented by a put. So we're going to do this. And in this situation again, all right, now instead of representing the ability to buy at 300 no matter what the price does, now the owner of the house maybe takes out as an insurance policy in case the market starts to crash a put option and says, okay, well, I want the ability no matter what happens to the house to sell at a price of $200,000 for the next year. Well, in this case, again, still no intrinsic value. Okay, value of the house is $250. If you could sell it at $250 today, why would you exercise the ability to sell it at $200,000, $50,000 less than what you could get for it on the open market? You wouldn't. It just doesn't make sense. So this is still an intrinsic value of 0. We're going to assume that all things remain the same and that the time and volatility would represent $20,000. In both situations, whether it's a call, an expectation that the market will increase, or a put, an expectation that the market will decrease, you're still paying these two values for the contract. So total cost of the contract, we're going to say, is $20,000. Not too bad. If you factor it in, how much is that? That's 8%. That's a little expensive for an insurance premium. 8% insurance premium. But for a full year, that's kind of what you would expect in the stock market. And this is why when I talk options for folks, I do kind of caution against the practice of buying puts as an insurance premium in case the market crashes against your securities, because at the end of the year, if you were to buy this contract, you paid 8%. Well, what if all things remained the same in the stock market and nothing actually changed? Well, then that 8% is gone out of your account. If the stock stayed flat, then you're down a loss of 8% instead of being flat. If the stock declines, but it doesn't decline by the amount you expect at the end of the year, then you're out that still 8% because you wouldn't have exercised your contract. Now, let's say it does go down more than you expect. Why didn't you just choose to sell the underlying asset before it dropped? You're paying an 8% premium to protect yourself from an action you're perfectly capable of taking at any point in time in the market. So for me, the concept of buying options is really tough to get people to discount, because what happens a lot of times is they say, well, I don't have $250,000 to buy the house, but I do have $20,000 to spend to buy the call option. So now instead of an insurance premium on the put, right, I'm trying to protect my $250. Now I'm speculating. I'm saying I'm thinking it's going to go up. Well, what a lot of people don't factor in is the actual cost of the transaction. Cost equals strike price, which in this case is $300K, plus the premium paid. So what is the cost of this actual transaction now? A stock, or a house in this example, is at $250,000. But what you're telling me is you think over the next year it's going to go up in value. Now, in order to do that, you buy the contract, you purchase it, and the stock, the price does actually increase from $250,000 to $300,000. Woohoo! You're in the money now. But you forget, you paid this premium to have that contract. So your actual cost is now referred to as the break-even price. You're not even making money at this point. You have just guessed correctly where it goes. All right? What if this happens or doesn't happen for 13 months instead of 1 year? Right? The price of the house increases to $305,000. In which case you would have made $5,000, but it didn't happen until month 13. So your option expired. This is no longer usable at month 13. That's only good for 12 months. And that's the situation that a lot of people miss or discount when getting introduced to options. Another thing to consider, your break even is 320 because you paid 20,000 for the option. Your strike price is 300,000. You only make money if it goes over this number. So let's say it gets to 330. All right. High side, big increase, right? Price increase. 330. Gain equals 10,000 at that point. And I know it's not big enough, so we're going to drag this down. That's actually not bad. All right, $10,000 gain. But how much would have you gained if you had just bought the house in the first place? Well, you gain 330 minus the cost of the house equals $80,000 gain. If you just bought the house. And this is why, again, I don't like buying options to start. But this is a fantastic example on how the mechanics actually work. So now to surmise, I just want to run it down real quick. Options are attractive to folks because it does give you access to more capital. In this scenario, it costs you $20,000 to buy it. It really does. All right. Not that expensive when you compare it to the actual value of the house being $250,000. Much easier to get access to, and a lot of times in options, you see the same thing, right? The stock might cost $130 per share, but you can buy an option that represents 100 shares and purchase it instead of buying it at $13,000, you could buy it for, say, $200. So it does provide leverage, which is great. You don't ever actually have to own the house or the underlying stock when you're talking about options. That is a plus if you understand what you're doing. But the drawback is you're not actually making a lot of headway in this scenario. In order to break even, it has to hit your price target of $320,000, which is your contract plus your strike price. Okay, your contract cost plus your strike price. And then your gain, should it increase beyond that point, only is represented by subtracting that break even. So when you take these things into consideration for options, you'll understand a little bit better as to why I don't advocate buying options. However, I did also prepare a conversation on selling options. This does require more capital. I understand. You should also be aware that there are tax consequences in doing this in a non-retirement account. So if you're not doing this in a traditional or a Roth IRA, most 401ks are probably not going to give you access to this strategy, except for self-directed, and even those have restrictions. So understand that this is not accessible to everyone, but this is my preferred approach to actually tracking or making money off of options, because when you understand this mechanic, you're going to better position yourself when it comes to making options purchases. And this is covered options. We're going to focus on cash secured puts and covered calls. In my example, I'm just going to use the covered call only as the example, and we're going to work from there. So let's go pull a random stock. Oh, look, I have the SPY up there. Let's use the S&P 500 index. It's as good as any. So right now, this is the S&P 500. It's currently trading at 393. SPY 393, just for my own reference. And we're going to say that you're long. Okay. Now, to buy 100 shares of this, 393 times 100, you're going to need at least $40,000 to do this transaction, right? Or $39,300 if you're being exact, and whatever change the underlying happens to be. So $39,000 just to start this, and that's only representative of 100 shares of the SPY. So understand that. That is an issue, and it is inhibitive to many portfolios. But if you are looking for a small portfolio to buy, hopefully this gives you a little insight as to what many of the sellers in the market are doing, because they understand this whole time and volatility aspect. That is the juicy and attractive thing. Higher volatility goes up, the more they can charge. All right. The longer the time is between expiration, the more they can charge. That being said, new sellers, I recommend that you target selling between 30 and 45 days out as you get started into it, because that time frame, you're losing 70% of the time decay value within that last frame of the window. Okay, an option that goes 90 days out, you're going from, let's say, 90% of the time volatility premium down to that last 30 days of being about 65-70% of the time volatility value. So the decline for 60 days at that point represents between 20 and 25% of time decay, whereas the last 30 days, which is half the amount of time, represents time decay of 65 to 70% of that value. So that's a little trick that's really important to understand when you're getting into selling options, and that's why I target the 1 month out, is because of that mechanic. That being said, though, starting options price, we're gonna do covered calls on the S&P 500. So let's use a real example here. Also, understand, if you're watching this on a video on demand or on YouTube, as is expected, prices are going to change. They're probably going to change a lot by the time you see this video. So this is not representative of what you will find today. We're going 30 days out. Look at that. Sweet spot. April 16th, 30 days away. That's a nice timing. So generally speaking, when you sell covered calls, you sell at or slightly out of the money, because the overall goal is to actually keep the asset and continue using this as an income strategy. You can look up, other YouTubers have gone into great detail on explaining the mechanics of the wheel strategy. I will do the same eventually at some point, but this is just your introduction to options. You're ready to make your first options trade. So what we're looking for is we're going to go ahead and go just one strike out of the money, $3.95. I don't think that's too far out, and we're getting a price right here between $5.58 and $5.57. Okay, I have the bid, which is here. That's what people are offering to buy at. I have the midpoint, which is between the buying point and the ask, which is the selling point. So whenever you're projecting out on options or looking to enter into a trade, probably consider targeting the midpoint for your projections. And then when you're ready to actually buy, you would look at the ask. When you're ready to sell, you would look at the bid on how much you can get. But for examples, I like to stick here. So I'm gonna call it 550 because we've seen it drop down to 548 and as high as, again, like 556, I think was the highest we saw. So 550 is what we're gonna use for our example here. All right. And one more piece of information that I actually need here is to understand the premium. So we're going to move that way over. So intrinsic from the last slide that I had. And T and V is what we're going to call it. That's time and volatility. Now, strike price. I think I also need that here. So, and we went $3.95. More important info. Okay. From the previous example here on the house, we're doing the same thing. House value, $250. Strike price, that's important. So this tells you if the strike price is above the actual value of the underlying. For a call, it doesn't have any actual intrinsic value. So we went from $3.93 to $3.95. Well, that's $2 out of the money, so that's a zero. So in this case, zero on the intrinsic. And then everything left over in the actual options premium, which is $5.50, is now considered time and volatility premium. Now, the next things that we want to look at here is to understand that how does this decay over the calendar. So you'll notice that in my calendar, I've got the delta, the theta, and the price. So I'm going to do this just a couple of times. I'm not going to go through the whole calendar. Don't worry. I'm going to actually just kind of jump around and project. But we'll do the first two and then I'll pick a couple of dates throughout and count how many days that should become, and go from there. So markets are closed on Sunday. We're assuming that you're making this purchase on a Monday. Next thing that you want to know as an option seller is, what is the delta? What delta represents, okay, when you're talking about options, there's multiple Greeks. There's 5 total, 4 I pay attention to, that go into pricing what that contract should be worth. That's an advanced topic. We're not going to get into too many details today, but I will introduce the delta, and this is representative in the options price, how much the options contract value should change based on $1 move up or down in the underlying index. So this is the S&P 500. If the S&P goes up or down $1, then the change in the actual options contract price is going to be 44 cents. It's moving. It's a moving target during live markets. So 44 cents is what I'm going to call it, based on just kind of this action I'm seeing here. And then the theta, this is the next number that's important, is 10 cents, or representative of 10 cents. Theta is telling you how much the options contract is going to drop each day between now and expiration. This is also a moving target. You can see it's 10.34, 10.33. This can increase if you look at other options as high as 11 cents, and can also decrease if you look at other options as low as that's about 6.5 cents every day. So this is also a moving target and has multiple factors to go into its calculation. Like I said, that's a future thing, but right now, for your first covered options trade, these are the numbers that you're going to focus on to start the process. So we're starting at 550. First day, delta is 0.44. Theta is 0.10. And the options price itself, this is reflective of the option, right? Starting option price, 550, and that's what it was trading at. I'm going to actually get rid of the underscore so you can see it better. And we'll do this. Nope. We'll do that. Less confusing. All right. Here's our day one. This is Monday, and where we're starting. So this is assuming that there's a change. The next steps we're going to do is we're going to make assumptions on the change of the price of the stock and kind of project out how our week will go. It's not completely unheard of for the S&P to move 5 or 10 points in a single day. So I'm going to just use volatility swings of 5 points. So to kind of project out where it's at. On Tuesday, the very next day that we started this contract, we're going to make an assumption that the S&P 500 went up 5 points. So the delta still stays the same at 0.44. That's not a changing target. So I'm not going to type the delta and theta in every time, but I do want to highlight that this is going to be consistent across the board. All right. Now we're making a change of 5 points. So we have to factor in how much that's going to change the delta. Or how many times the delta is going to be calculated into the price. Understand, get it. I'm oversimplifying this because there are other factors like the gamma that also are reflective of change in price, but we're simplifying the delta for this example. So 0.44 times 5, because we're making an assumption of a 5-point move in the stock. That is representative of $2.20 now. So 44 cents for a 5-point move up now represents 2.20. Oops, 2.20. The theta by 5, I don't need a calculator for this one, 50 cents. Or I'm sorry, nope, I lied. That's 1 day, still 10 cents, because this is based on the day, not on the price move. And then the price now, or new price, is reflective. It is going to be the delta change. So in our example, the price went up. So new price of the option now is going to be the previous price, starting price, which was 550, plus the delta change, because this was an upward move, minus the theta decay, because that is still, this is a ticking time bomb of sorts. It's going to constantly just chip away, pick. Time runs out, clock keeps going, seconds tick away, theta ticks away. Just Just remember that. So this new price in the option goes from 550 to 770 minus 10 cents, which would be 760. All right, and that's assuming that the stock price went up of the S&P. Well, the ETF price went up. All right, so we went from 393 to a hypothetical 398 this day. Here's your new delta, right? That's changing. Here's your theta. One day is going away, and here's your new price on the option. So very next day, the opposite thing happens. 4.4 on the delta, but now instead of going up 5 points, the S&P went down 5 points. So that's $2.20, right? The 44 delta times 5. Theta stays static, 0.1. And then the new price is, again, a new factor. So now we're taking 760. We're subtracting this delta of $2.20. So that takes us down to 540. We are also then deducting the theta, which is 10 cents. So that takes us down to 530. So as an options seller, not only does the delta kind of work in your favor here, but the theta is a buffer to assume that you're going to continue to make money. All right, so this example was just a 5-point move, and it went up 5 days the day after you sold your covered call, down 5 days. And now you technically have a gain, because when you sell the option, your goal is to get this 550 as close to zero as possible. You want that to decay over time. Now, if you were an options buyer, obviously you would want it to go up. The options buyer is looking at this price action and be like, well, technically today, Wednesday, there is no difference to what the price was on the S&P 500 on Monday, because we're right back to 393 where we started, but somehow I've lost 20 cents a share or contract. And that 20-cent loss per contract is that time decay. So you can play with this back and forth on multiple points in the calendar. So I'm going to jump 7 days. We're going to go right down to the next Wednesday. And we're going to assume that between Wednesday and Wednesday, the S&P 500 makes a price move up of 10 points. So 10 points on the delta would be 4.4 as the change. The theta now, because we've gone 7 days, we're going to factor in this theta loss now for the full 7 days, which is 0.7 from here, because we're going from the last. And then your price action here is 530 plus 440 minus 70 cents. So this is 970 minus 70 cents. $9 is your options contract price. All right, and this is making the assumption that the price went up 10 points. All right, on the very next day, like I said, S&P can move 10 points in a single day. We're losing 10, which is another 4.4. You're only losing 1 on the theta, 0.1. And your new price now, because this is a down day, you're deducting the delta. So it goes from $9 to $4.60, because that's 4.4. And then you lose the 10, so this is now 450. And in essence, what's happened is Monday, 393. Tuesday, 398, up 5 points. Wednesday, back down to 393, down 5 points. The next week, it managed to inch away and grab the 10 points over the whole week, right? So we're assuming the delta was a positive on this day because it moved up. And now we got an options price contract of 9 points. The very next day, somebody came out, I don't know, Fed threatened to raise rates even though they keep saying they're not going to. And the market freaks out and sells off. Bam, 10 points gone in a single day. Now you're back to 450. So the option seller at this point in time, while there has been no change to the underlying S&P 500, is now sitting on an options contract at 450, meaning they've essentially pocketed a full dollar, and that is just by the power of this ticking theta decay. 10 cents every day, regardless of what happens, up, down, or sideways. All right. Delta moves are indicative. You would add the delta on an up day. You would subtract the delta on a down day. And that's oversimplifying the process because, again, when it comes to delta, you should be aware that there's also another Greek called the gamma, which goes into that calculation to understand how much that changes on the ups and down swings. But here's your basic introduction to options. Okay, how you're actually going to execute your first options trade. You're going to need some money. I've given an introduction on the theta, the delta, what the options premium is, how it relates to your strike price, and how to trade. So you want to do this your first time. First thing you need to know is you need to be able to buy 100 shares. Okay, next thing. Understand that covered options are an income strategy. All right. Your goal is to try to capture as much of the premium as possible. So, as an income strategy, you're trying to capture time and volatility premium. So what you're doing, in essence, is you're saying, I want to buy 100 shares. In the case of S&P 500, that is 392 or 393 in our example, dollars times 100. So really, easy peasy math on this one, 39300. That's it. It's 100 times. Okay. If you want to do more contracts, you have to do this in round lots. So if you wanted to do it twice, then you're moving up to 79,600. All right. Basically 40,000 minus 600 times 2. But that's what you're doing is you're then doubling the amount of capital. Okay. And what you're trying to capture is the options premium. Now, the options premium, when you sell it, you're only pulling in that 550, right? 550. But that's times 100 because it represents the full 100 shares. So that is $550 in your account. And this is where the magic happens. So let's take 300. 550 is the income. That's how much income you got from the premium. And how much of a yield does that equal? All right. I always tell folks, easiest way, you're going to do 550 divided by the 393. That's your cost. Divided by 300. That is 1.39%. All right. So for conversion on decimals, you just move the decimal over 2 places, and that gives you your percentage. So 0, that'd be 0.13. And then you move it over 1 more, it's now 1.39%. Okay, that's how much you're capturing. Now, 1.39% in the whole discourse of where the market's at right now. You got to understand, it's not super glamorous. But what does this represent over a year's time? Just take this number times 12. Now we've taken a boring 1.39%. on an investment that you were already managing at this point, and you multiply it by 12, now you've got 16.79%. And this is why I say so many people should focus on selling options first, because the option seller has a little bit longer of a time frame horizon. Generally speaking, I would hope that this is true for you, but if you don't understand this yet, covered options is not a strategy you employ in very volatile stocks. It is not a strategy you employ on any stock you are not willing to hold long term. This is a stock you want to hold for a long time. S&P 500 is an index. It's been proven as a good long-term investment vehicle if you're looking at 10 or 20-year time horizons. So it would be an acceptable candidate for a covered option strategy. Okay, but it doesn't have to be the S&P 500. You can pick a company like Apple or GM or any of the other recent stocks that IPO'd over the last year that may not have been overvalued. If you are planning on holding this stock for 5 to 10 years, you can generate nominal income off of this strategy over extended periods of time. And that's part of the reason why in my introduction I said in retirement accounts, because what can happen is if you do have the option exercised against you, you then have to sell it, which means if you want to still own it, you're going to have to buy it back. But every time you have a sale transaction in a taxable account, that is either short-term or long-term capital gains or potential losses, that you have to then report to the IRS. So in a retirement account, the buying and selling activity is not reported. It is only the depositing and withdrawing activity, which is why it makes more sense to do this in a retirement account. But that 16.79% annualized return on money that you already had invested is addition to the potential movements, as long as you continue the discipline of selling out of the money. So I gave you the mechanics of how to do it. I hope that the clarity and explanation on the delta and theta mechanic kind of helped trigger in your mind how it's working. If you want more information, I definitely recommend you come check us out on Twitch. We stream Monday, Tuesday, Thursday, and Friday, starting at 1 p.m. Eastern every single week, and we talk about all things investing, not just options. So feel free to stop by and ask questions live on this, because again, this is an introduction. I understand it's not going to answer more advanced questions, but hopefully it does make or do a good job at kind of making a case on how covered options work, and also understanding from the example earlier in the house how long options don't always actually equate to the gains you would expect otherwise. So with that being said, we're going to wrap up. Check us out on all the socials. This is Brian LeBlanc with Where Rebels Are, and I'll see you on Twitch.